If you're 65 or older, the IRS is quietly sitting on money that belongs to you, and most seniors never claim it. Not a scam, not a loophole. Real deductions and exemptions written into the law specifically for you that vanish every single year. You don't file for them, some are brand new for 2026, and the government does not send a reminder. This is the money you're leaving on the table of the 65 and exactly how to take it back. Here's what you have to understand first, because it's the reason this happens at all. The tax system is not on your side and it's not against you. It's indifferent. Every one of these breaks requires you to know it exists and to claim it. Miss the box, miss the form, miss the deadline, and the money simply stays with the government. Nobody at the IRS calls to say you overpaid. So let's go through them one at a time, and I'll tell you the specific action step for each. And I want to be clear about something up front. I'm not here to sell you anything or promise you a secret trick. Every single thing in this video is written plainly in the tax law right now. The only reason it feels like a secret is that nobody whose job it is to collect taxes has any reason to advertise the ways to pay less of them. Start with the biggest one and the one almost nobody has heard of yet, because it's brand new. For tax years 2025 through 2028, if you're 65 or older, there's a brand new bonus deduction worth up to $6,000 per person. $6,000. If you're married and you're both over 65, that's $12,000 knocked straight off your taxable income. It came out of the recent tax law, it's temporary, and here's the key part. It works whether you take the standard deduction or itemize. You don't have to do anything fancy, but there's a catch you need to hear because it phases out. For a single filer, it starts shrinking once your modified income passes $75,000, and for a married couple, once you pass $150,000. Under those numbers, and you're 65 or older, this is very likely yours. Your action step this week: make sure whoever prepares your taxes knows you qualify for the new senior bonus deduction. If you file yourself, look for it directly. It's new enough that some people are going to miss it entirely this year. Now stack the next one on top, because they combine. Completely separate from that new bonus, seniors have always gotten an extra standard deduction just for being 65 or older. For 2026, that additional amount is $2,050 if you're single, and $1,650 per qualifying spouse if you're married. This isn't either or with the bonus. You get both. Add it all up, and for 2026, a single senior's total standard deduction climbs to around $23,750. And for a married couple where both are over 65, up towards $46,700. That's income the federal government cannot touch. For many retirees living on Social Security and a modest pension, that deduction alone can wipe out most of their federal tax bill. The action step: never let a preparer use the regular under 65 standard deduction on your return. Confirm the over 65 amount is the one being applied. Here's the third one, and it's a credit, which is even better than a deduction. A deduction lowers the income you're taxed on. A credit lowers the tax itself, dollar for dollar. It's called the credit for the elderly or the disabled. If you're 65 or older or permanently disabled and your income falls within certain limits, you can claim it using Schedule R on your tax return. It's aimed at seniors living on fixed, lower incomes, and it's one of the most overlooked credits in the entire tax code, precisely because the people who qualify often don't file complicated returns and never hear about it. The action step: if you live mostly on Social Security and a small fixed income, ask specifically about Schedule R, the credit for the elderly, or disabled. Most software skips right past it unless you go looking. Now, let's talk about the one that touches almost every senior who owns a home, because this is where the really big money is: property tax. Nearly every state offers what's called a homestead exemption, and most of them have an extra layer specifically for homeowners who are 65 or older. This can freeze your home's taxable value so it stops climbing as you age, or knock a large chunk off the value you're taxed on, or in some places, freeze the tax bill entirely. In Texas, for example, the senior homestead exemption stacks on top of the regular one and can push a huge portion of your home's value completely out of the school tax calculation. Some states let a qualifying senior stop paying certain property taxes almost entirely. But here's the trap, and it's the same trap every time. It is almost never automatic. You have to file for it with your county, usually once, and there is a deadline. Miss it, and you pay full price for another year. The action step: search your county's name, plus the words Senior Property Tax Exemption, go to the official government site, and confirm both the age rule and the filing deadline. Do it this week, because these deadlines pass quietly, and there's a piece of this most seniors get completely wrong, so let me clear it up. Selling your home. If you've lived in your home for 2 of the last 5 years, you can exclude up to $250,000 of the profit from taxes if you're single, or up to $500,000 if you're married. A lot of older homeowners sitting on a house that's tripled in value are terrified of the tax bill if they downsize. For many of them, that fear is misplaced, because that exclusion wipes out most or all of the gain. The action step: before you ever let anyone scare you out of selling, find out how much of your gain is actually shielded by that exclusion. It's often far more than people think. One more that catches people off guard: medical expenses. Once you're retired, healthcare is often your single biggest cost, and the tax code knows it. If you itemize, you can deduct medical and dental expenses beyond 7.5% of your income, and that can include things people forget, like long-term care costs, certain insurance premiums, even travel to appointments. The action step: if you have significant medical bills, keep every receipt and have someone run the itemized math against the standard deduction. Sometimes itemizing wins by a lot. There's one more area worth understanding, because it's the one seniors ask about more than any other: taxes on your Social Security itself. A lot of people are furious to learn their Social Security can be taxed at all after paying in their whole lives. Here's how it actually works. Whether your benefits get taxed depends on what the IRS calls your combined income. Below certain thresholds, none of your Social Security is taxed. Above them, up to half, and then up to 85% of it can become taxable. But here's what connects it to everything we just covered. All those deductions, the new $6,000 bonus, the extra standard deduction, they lower your taxable income, and a lower taxable income can mean less of your Social Security gets taxed. They work together. The action step: if your income is anywhere near those thresholds, the deductions we talked about aren't just saving you on income tax, they may be quietly protecting your Social Security from taxation too. That's a reason to claim every one you can. Now here's the honest part, because this channel doesn't deal in fantasy. Not every senior qualifies for every one of these, and a few of them interact. Claiming a large gain from selling your home, for example, can raise your income for that 1 year and temporarily affect other benefits. The new bonus deduction phases out at higher incomes, And state rules vary enormously from one place to the next. None of that is a reason to skip them. It's a reason to actually check each one against your own situation, instead of assuming it doesn't apply. The default assumption most seniors make, that they probably don't qualify, is exactly the assumption that costs them the most money. Because step back and look at the pattern across all of these. Every single one requires you to raise your hands. The new $6,000 deduction, the extra standard deduction, the Schedule R credits, the senior property tax exemption, the home sale exclusion, the medical deduction. In every case, the money is legally yours, and in every case, it stays with the government until you specifically claim it. Nobody is coming to make sure you get it. The wealthy have accountants whose entire job is to raise that hand for them. The average senior has to know to do it themselves. So here's what to actually do this week. Make a short list: the senior bonus deduction, the over 65 standard deduction, Schedule R, and your county senior property tax exemption. Then either go through them one by one with whoever does your taxes, or if you file your own, look each up by name on the IRS site or your county site. You don't have to master the tax code, you just have to know these exist and ask, because asking is the whole difference between keeping this money and handing it away. This is educational information, not personalized tax advice, and every amount and rule here can change with your state, your income, and the year, so verify your own situation or talk to a tax professional before you file. But now, you know what's sitting there with your name on it. If this showed you even one thing you were about to leave on the table, subscribe, because on this channel we break down exactly what the rules actually say, one real number at a time, so you never overpay again. I'll see you in the next one.